Going on this side. Yeah.
He's working. So you might want to have him stand at the presenter's position and we frame you.
I like to walk around a little bit. Yeah.
Okay, this is the audio. So he is familiar with what we do, and he also puts in his own personal time trying to put on other events. One of our board members, Alison Pulaski, has given presentations at the San Diego chapter and recommended Rob highly. And so Rob is actually going to present one, I think it's his first presentation, is an approach very similar to one that Al presented in about 2010, in which I have subsequently done and used. So interesting. So he is president of RGB Capital Group. He manages personal and client portfolios, but he's very familiar with the AAII approach to life of trying to educate people to do things for themselves. Prior to starting that, he was a consultant with Deloitte Touche for over 11 years and served 4 years as Chief Information Officer at Newland Communities, a real estate development company. He received his BA in Quantitative Economics and Decision Sciences from the University of California, San Diego, an excellent institution, and an MBA in Finance and Accounting from William E. Simon School of Business at the University of Rochester in Rochester, New York. He holds a Series 65 licenses, has a CPA license, retired, is the president, as I said, is the president of the San Diego chapter, and serves on the board of the National Association of Active Investment Managers. So with that, it takes me great pleasure to introduce Rob Bernstein.
Let me throw a couple of comments in first. It'll take us 2 weeks because SOC is in India to get this program posted on our website. So that's going to take a little longer. There's just a lot of, it's amazing how many things people do when they're not here. You have to figure it out. And thank you for your patience. Everybody knows where the restrooms are. And basically you've got from now until 10:15, we'll take a 10-minute break where we'll have a drawing for our investment book, and then we'll go on from there. So welcome and thank you for coming.
Great, thank you. Can you all hear me? Great, well, thanks for having me up here this morning. It's great to be here. I spoke at the San Francisco chapter about a year and a half ago, and all I remember is being really cold. Being from San Diego, I'm used to the sun. It's always chilly. Not quite as chilly as the San Francisco meeting I was in. People had hoods and gloves on. It was miserable. So this is much better, much better. They mentioned access to the presentation. If you would like access to the presentation prior to 2 weeks from now, there'll be a way for you to share your email with me. I'm happy to send that to you on Monday morning. So I'll talk a little bit more about that later on. Make sure this is working. Not working. Oh, the dongle's still sitting in here. I wonder why it doesn't work. There, it's working. Okay. Well, again, thanks for having me. What I'd like to do is start out with a chart of the stock market. This is almost a 20-year chart, and of the S&P 500. You can see that on the left-hand side of this chart, we went through a period of volatility. First 13 years of the S&P of this century basically resulted in no return. If you held the S&P 500, you declined through the tech bubble. We had a nice run up after that, got right to the highs, and we fell again in the financial crisis. Since that time, we have had a nice run up of above average returns in the S&P 500. So just curious, how many people here think that this recent run will continue for another 3, 4, 5 years? Anyone? No one? Not a single person? Usually I get someone. How many people think we may see another substantial decline in the market in the next 3 to 5 years? Well, similar to a tech bubble, similar to a financial crisis, 30, 40% decline. A few hands. Truth is, we don't know what's going to happen, right? We have no idea what the future holds. All we can do is look at historical charts, look at patterns, and try to make plans for the future. And as Benjamin Franklin was credited with saying, if you fail to plan, you're planning to fail. And so what I would like to do today is share with you my plans. My plans that I use for myself, for my mom, and for my clients. And that's going to be done through 2 presentations this morning. The first presentation will be on managing what I consider kind of the core of your portfolio, a very well risk-managed strategy to manage the core of your portfolio. The second presentation will be focused on managing equity risk in your portfolio, which tends to provide a lot more volatility on a day-to-day basis. So let's start off. What I'd like to do is get a common understanding of risk. So what I'd like to do is share with you how I view risk. This chart is a chart that in the red area, it represents the potential loss that you could potentially incur in your portfolio. It goes from 10% down to 90%. The area in the green shaded area is the amount required just to break even, right? So if you have a 10% loss in your portfolio, you need about 11% gain just to recover what you lost. A 50% decline in your portfolio requires 100% gain to break even, right? If you had $1 million portfolio, you lost 50%, you now have $500,000. You need 100% of that $500,000 just to get back to that break even point. And so the further you go into that hole, the more exponentially difficult it becomes to recover, right? Anyone invested in the NASDAQ during the tech bubble, that was a 70, 75% decline. It's almost a 300% gain to break even. And unfortunately, I had an experience like that. When I started investing, it was in the late 90s. I bought some tech stocks, and I thought I was pretty darn good. They were all going up until they didn't. And the tech bubble burst. I owned a stock. It was Cree Research. Am I familiar with Cree? It was had a nice run up, and the tech bubble burst. It fell. It fell. I didn't hold on to it for the entire fall, thank goodness, but it fell over 80%. Fell about 85, 90%. That's over 500% gain just to break even. And I looked at the chart before coming up here. It still has not recovered. It has not achieved past that previous high. And so what we need to do is look at how do we protect ourselves from the large declines in the market. Because it has an exponential, has a dramatic effect on our ability to create wealth. So on this chart here, we've got 2 lines. There's a red line and a green line. The chart I want to look at here. The red line is the SPY, the ETF that tracks the S&P 500, and the green line is a mutual fund that tracks a floating rate fund. They both start at the same place. They both end at the same place for this given time period. How many would prefer to be on the red line? With perfect hindsight, obviously. Got any hands? Who would prefer the green line? Most people in this room. Why is that? Steady return? Anyone else? Less volatility. Right, so the way I look at this is risk is the uncertainty of a future outcome, right? And so with the green line, you have more certainty of what tomorrow might bring. Sorry, I can't use this pointer on these screens. Let me see if I can use this. So at this point down here, we don't know if the market's going to continue to go down or if it's going to bounce and go up. However, if we're invested in a investment that has much lower day-to-day volatility, we have much more certainty that if it does go down, it's certainly not going to go down by a whole lot. And so that, by looking at investments this way, we can see that floating rate fund has a much lower volatility. And all else being equal, as you represent in this room, most investors would prefer the lower volatility green line. So it's helpful to quantify volatility. One way we can do this is through a measure called standard deviation. Standard deviation simply measures how much a investment fluctuates on a day-to-day basis around its mean. In this case, the standard deviation of the SPY was 3.77, and the standard deviation of the floating rate fund was about 0.6, a fraction of the overall volatility of the S&P 500. So that's one way we can measure volatility. Now, standard deviation does have some limitations. Standard deviation of a straight line is 0. So it provides no indication of the strength of the return, right? So I have two lines up here. One's a 10%, one's a 25% constant return line. They both have a standard deviation of 0%. That's the definition of a straight line. There is no variation. The other limitation of standard deviation is it gives no indication as to whether it's upside volatility or downside volatility, right? These are two lines. One doesn't really matter what they are for this purpose. One has 7.02%. Basically, they both have 7% standard deviation. One provided a positive return during this time period of 8.5%, and the other provided a minus 25% return. So standard deviation doesn't give us any indication as to the strength of that return. So it's helpful to plot standard deviation in context of annualized return. Many of you have probably seen a chart similar to this, what I call a risk versus reward chart, where we have risk on the bottom x-axis and annualized return on the y-axis. Lower risk on the left side and higher risk on the right side. And of course, annualized return. What I've done is I've plotted some of the major indices, as well as a Vanguard bond fund and a money market fund. And with this regression line, we can see that there's a trade-off between risk and return. So higher, the more risk we take or expose ourselves to, the higher return we might expect. Of course, there's no guarantees of that actually happening. And most investments fall into what I call the long-term expected return channel, which is the area between the two dashed lines, which are the two parallel lines to that regression line. And that kind of represents what you might expect for a given level of risk that you take. As investors, we have control over how much risk we expose ourselves to. We have zero control over how much return we get. So for example, we could choose to put our entire portfolio into a money market, right? Now, if we did that back in the 80s, we might have got nice returns. We did that over the last decade, we got very little return. So, but either way, there was very little volatility associated with the money market. We could also choose to put our money into the NASDAQ 100 if we wanted to. We have that choice to move out on that risk scale and put our portfolio in there. So we have all the choice of how much risk we expose ourselves to but the return we get for that time period is uncertain, right? So as investors, what we'd like to do is get into this upper left-hand quadrant of this chart, there it is, which is what I call better risk-adjusted returns. So is everyone geared towards being in this upper left-hand quadrant? Is that what we're all seeking as investors? Yeah? Okay, so we're all on the same page. Let's talk about a few other metrics for measuring risk. One is called drawdown or retracement. And all drawdown is a percentage price decline from a peak to a trough before it bottoms and exceeds that previous peak. And so on this chart, you can see there's several drawdowns during this time period. There's very small drawdowns here and here. This larger drawdown for this period is what we call the maximum drawdown. Maximum drawdown is just the largest drawdown, peak to trough percentage decline for a given time period. And this is something that's pretty tangible for most investors, right? It's something that we can relate to. When we see our portfolio go down by 5%, we know that, right? We feel it. We see it in our bank statement. So drawdown is a very useful metric to use in terms of measuring overall volatility risk. Just like standard deviation, it also has some drawbacks. One thing is it doesn't provide any sense of duration. How long did that drawdown last? So the drawdown in the S&P 500 during the financial crisis, that lasted many years, right? Other drawdowns could last much shorter time period. So what I like to use are two metrics called the Ulcer index and the Ulcer performance index. And as the picture indicates, it really reflects how much pain it's going to cause when volatility increases. Now, the Ulcer index is a downside volatility metric that incorporates depth and duration of drawdown. Lower UI values represent less volatile investments, while higher UI values represent higher volatility investments. Now, the Ulcer Performance Index also incorporates not only depth and duration, but also incorporates strength of return. So it's very similar to the Sharpe ratio in that if you're familiar with how the Sharpe ratio is calculated, it's the annualized return less the risk-free rate of return divided by the Ulcer index as opposed to standard deviation. So the Ulcer index is a measure of downside volatility. And the reason why I like using the Ulcer index is focused on something that we're interested in as investors. We're interested in downside volatility. We all like upside volatility, right? When we get upside volatility, that means our portfolios are growing, the balances on our statements are going up. So this focuses us on things that matter to us, which is downside volatility. Now, unfortunately, given our time constraints here, I can't go through all the calculations of how to calculate the Ulcer index today. But if you are interested in more details of how that is actually calculated, I have a document on my website. The web address is listed on the slide there. You can certainly go to that link and pull down that document to give you some details on how that's calculated. But I think these are two useful metrics in terms of measuring overall volatility, in terms of depth, duration, and then also strength of return. So just to give you a visual representation of what this might look like, I've plotted two lines here. Again, this is for a period, 10-year period. The S&P 500 in red and the Merrill Lynch High Yield Master 2 Index, which is an index of junk bonds, which we'll talk about a little bit more in a minute. They both, again, started at the same place and roughly ended at the same place. You can see their annualized returns are just a little bit over 8%. Standard deviation for both of them. But the Ulcer index of the high yield index is 6.1 versus 10.5. So again, lower values indicate lower volatility, and you can visually see the lower volatility in those two lines, right? Or lower volatility of the green line versus the red line. And also the UPI, the Ulcer Performance Index, which is the strength of return, is a higher UPI values represent higher strength of return, is 1.09 versus 0.86. So what it does is the UPI is representing the additional return you're achieving for an incremental level of risk. So for every given level of risk that you expose yourself on the green line, you're getting a higher return for that incremental level of risk. Yes.
You're showing us. I'm sorry. You're showing us a couple of investments, S&P and a high yield index. Is that
Yep.
right?
Correct.
And then the Ulcer index is being graphed on the y-axis or the.
So I think the question is, what are we looking at on this chart? So the green line is the high yield index. The red line is the S&P 500. Those are the only two lines that are plotted on this chart. What I've done is just in those two boxes provided the values that are calculated based off those two equity curves. Okay, so I'm just trying to give you a representation of how the UPI and UI would work and what those corresponding lines look like. So you can see the green line has less volatility. You can visually see that. As a result, it has a stronger UPI value, which represents a stronger risk-adjusted return. Yeah, so
Could you repeat the question?
So the question, yes, of course. The question was what's being represented on the y-axis. The y-axis is a total percentage return of each of those lines. Yeah, total return for those lines, meaning it's price appreciation and dividends reinvested of those two lines on a percentage basis. And so you see on the right side of the chart, let me get the pointer here. So the total return for the red line is shown in that it says annualized, or between polls is 126%, annualized is 8.51%. And on the green line, the total return for that time period is 123%, annualized at 8.4%. I'll get more into these charts as we get into the next section, so I'll make sure you understand how to interpret these charts. Okay. So moving on. So what I wanted to do is just establish that common language around risk so that we can now talk about a strategy that manages day-to-day volatility and manages risk. And it happens to be a discussion about junk bonds or high-yield bonds, which to me is the epitome of a low volatility investment. And let me kind of share with you a little bit of background on junk bonds. So what I like to use as a index to track this market is the Merrill Lynch, now it's a B of A Merrill Lynch US High Yield Master 2 Index. This is an index, which you're seeing on the screen here. It tracks the US domestic junk bond market. Basically, for inclusion in this index, it has to be a below investment grade bond, has to have 100 million outstanding fixed coupon schedule. But basically represents the junk bond market in the United States. And this chart, you can see, goes all the way back to 1997. Down here, this is the financial crisis, which is that big drop right in the middle. And you can see the run up through there. You had a little bump in the road in 2015 and 16, if you remember that, what I call the mini bear market. And then this goes up into the end of 2008. So this is what I'm going to use as the basis for our discussion this morning in terms of this junk bond strategy. So, but before we go into that, I'd like to talk a little bit about how junk bonds behave. Because junk bonds are a unique instrument. They have the word bond in them, but they act very differently than the typical corporate bond or U.S. Treasury bond. And let me see if I can kind of share with you why that is. So the red line on this chart is the junk bond index, and the green line is the IEF. It's the 7 to 10 year Treasury ETF. You can see this chart is from 2011. Both junk bonds and Treasury bonds were trending up for the first half of the year. And then something happened in August. Treasuries shot higher and junk bonds collapsed. Does anyone remember what happened in August of 2011? I know this is going back a little bit. But what happened in August 2011 to cause that change in the market? Any memories there? That's correct. So in August of 2011, our elected officials were debating whether or not to raise the debt ceiling. And they were threatening to not do that. The US was going to potentially default on our obligation. So as a result, risk rose in a very short time period, correct? Like there was a risk that the US was going to default on their obligation. What happens during times of higher risk? Investors flee to the safety of US Treasuries, correct? So that drove additional demand, drove Treasury prices higher and Treasury yields lower. But at the same time, in a period of increased risk, investors that are holding junk bonds, which are riskier assets, right, the below investment grade assets, demand a higher yield, right? They want to be compensated for that additional risk. And so when yields rise on bonds, whether they be treasuries or junk bonds, what happens to the price? It goes down. So that's why you see junk bonds going down. And when risk rises in the stock market, what happens typically? Prices go up or they go down? They go down. So you can see that junk bonds have very similar characteristics to both bonds and equities, right? And that's why you see this decline here, while at the same time treasuries were rising. Let's look at another example. This chart is from 2014. Again, treasuries and junk bonds were trending in the same direction for the good portion of the year. And then something happened about September, October timeframe, where treasuries shot higher and junk bonds prices declined. This was kind of the beginning of the global growth concerns that kind of led into what I call the mini bear market of 2015, 2016. Price of oil was declining very fast, and it went from 100 down to about $25 during that time period. We see the same sort of thing. So we can look back at these charts, and periods of elevated risk, you're going to typically see junk bonds go down and treasuries rise. And so that's a really important concept to understand when dealing with junk bonds. Question? Okay.
It looks like the dip there towards the right, the junk bond could be like 200 to 400%. I don't know what the percentage is, but
Yeah.
it looks like it's more than 100%. So going back to impact of losses, it looks like you might need 1,000% to get back where you were. And I don't see the commensurate contrary, the one the previous slide, the treasuries that took off to compensate for that. Maybe I'm overreading it, but that's kind of like a broad, my broad assessment.
Okay. So the question is, what type of drawdown? We talked about drawdown earlier. Now, what kind of drawdown are we looking at here? We're going to get into the drawdowns on junk bonds in the coming slides. So I'm going to hold off on that question, if I could, and answer it in the upcoming slides here. So this is the Merrill Lynch Master 2 Index going back to 1997, plotted in red, and it's plotted against the S&P 500, which is in green. And you can see that with the exception of the run-up prior to the tech bubble, junk bonds generally follow the same general direction as the stock market, as the S&P 500, which makes sense, right? We just talked about the fact that when risk rises, junk bonds tend to fall because investors want to be compensated for that additional risk. And during good times, when the economy is strong, risk is pulled back, those yields fall and junk bond prices tend to go up. So you can see, went up, down, and went back up with the rest of the market. During this time period, which is quite an extensive time period, junk bonds returned 6.5% on an annualized basis. The S&P returned about 5.7% on an annualized basis. But the important thing here is that junk bonds provided those returns on a fraction of the volatility. Standard deviation of the red line is 1.3% versus 5.5%. So when we talked about getting up into that upper left-hand quadrant of that risk return chart, we're talking about reasonable returns on lower volatility. So the junk bond index over these longer periods of time can help us get up into that upper left-hand quadrant. The other things that you notice out of this chart is that junk bonds, just visually, you can see that the junk bond index has much lower day-to-day volatility, right? And we said a low volatility line, there's nothing less volatile than a straight line. When you look at this period here, during the financial crisis, that is almost a straight line down, right? So very low volatility in both up and down markets. And then it bounced and went back up, and it's almost a straight line going back up. So very low volatility type characteristics. And junk bonds have what they call very high day-to-day serial correlation, meaning that they tend to trend in the same direction for a period of time before that trend changes, and then they tend to trend in the opposite direction for a period of time until that changes. So it's that high day-to-day serial correlation, that low volatility, and what I would consider reasonable return characteristics of junk bonds that make them an attractive investment for many investors. So let's look at this on our risk reward chart. This is the same chart we looked at earlier. And if we plotted the junk bond index on this chart, it would start to get us outside of that long-term expected return channel and into that upper left-hand quadrant of the chart, right? So we've taken a small step out on the risk scale, similar to a bond mutual fund, and we're starting to get a little bit higher return. So the question is, that's good, it's going in the right direction. Can we do better? Well, the answer is yes, or this would be a very short presentation. So let's talk about that. So this is a chart, there's a lot of information on this chart, so let me try to walk you through what you're looking at here. So the top half of this chart is simply the Merrill Lynch Master 2 Index. This happens to be from the year 1998. And it's plotted with a 50-day moving average in purple, okay? During this time period, it provided a just under 3% return for that year. And the standard deviation, the measure of volatility, is about 1%, okay? The strategy and the approach that I'm going to talk about today has to do with timing these junk bonds using a moving average. In this case, a 50-day moving average. The concept works like this. When the junk bond index is trending above its moving average, you want to be holding that asset. And when it's trending down below that moving average, you want to sell that asset and move to cash. This bottom part of this chart has actually two lines on it. It's a red line, which is simply the Merrill Lynch Master 2 Index. And there's what I call a composite line, which is a red and green line. The red and green line reflects the results of moving into and out of the Master 2 Index, the junk bond index, and cash based on where it sits relative to its moving average. So up until this point, it represents the fact that we were holding the junk bond index. It moved, once it dropped below at point B, we moved to a money market. Back here, money market's actually paid something. That's why there's an upward slope to that green line. And then when it went and crossed above its moving average again, we got back into junk bonds and held them through the remaining period. As a result, we went from a 3% return for the year to a 9% return for the year. Not too bad. But even better, we went from a 1% standard deviation to 0.5%. You see where we're going with this? We've got a higher return on lower volatility. And that's what we're trying to do here. And so what I call the point, the drawdown from A to B is just what I called time drawdown, right? It's based on a timing strategy using the moving averages. That area from A to B is about 1% on this chart, and certainly a lot better than the almost 9% decline from A to C, which is what I can call total drawdown. And so by using a moving average, we will always avoid the large drawdowns in the marketplace. However, it will not always provide larger returns. So here's another example. This is 2003. The junk bond index in red, the 50-day moving average in purple. Point A to point B was about a 2% drawdown. Point A to point C, total drawdown, was about 3.7%. Now, if we took that trade, you can see what happens in the lower half of this chart. We actually ended up with slightly less return. So the point here is, this isn't a perfect strategy. There is no perfect strategy. But what it does do is it will provide you the confidence that you will not sustain those large losses in your portfolio, going back to that original slide, so that you don't have to spend a lot of time recouping large losses. This will always protect your downside. It will not always provide excess returns. Sometimes it does, sometimes it doesn't. Where it does provide the excess returns is during periods of large decline. The tech bubble, the financial crisis, the 2015-16 mini bear market, and even the 2018 fourth quarter meltdown, if you recall from last year. Probably still fresh in some of your memories. So how did this work during the 2008 financial crisis? So this is a period of 2008, 2009, so it's a 2-year chart. You can see junk bonds were above their moving average at point A, it crossed below point B, and then from point A to point C was, I think it was about 35% versus a 1.5%. So if you took that trade and then got back in at the end, there's a little bit of a whipsaw there. A whipsaw is simply an unprofitable trade. As I said, it's not always going to provide a profitable trade. It will always protect your downside, and it's what you see here. The composite line, the red and green line on the bottom, provided a 28% annualized return during this 2-year time period versus a 7.6% annualized return. I don't have the volatility on this slide for some reason, but I can tell you the volatility was significantly less. And we provided ourselves a much higher return during this time period. So what I call time drawdown, A to B, is very predictable. Over the history of this index that I have, the drawdowns are typically in the 1 to 3%. And so as investors, 1 to 3% range drawdowns is not really that significant. Total drawdowns, however, can be very significant, as we saw in that case of a 35% drawdown during 2000. So total drawdowns, very unpredictable. The time drawdown is very predictable. So what does this look like if we go back to the beginning of the history that I have for this junk bond index? You can see and again, the top half of the chart is simply the index plotted with its 50-day moving average. The bottom part is the composite line in red and green, the Merrill Lynch index in just the solid red line. So over this time period, annualized returns went from 6.5 to 10.5. Standard deviation went from 1.3 to about 0.8. Again, going further up into the left of that risk reward chart. And the maximum drawdown of this strategy over this time period is less than 6%. Yes.
I can't quite pick it out from the chart. How many times would you end up getting in and out of the high yield investment over the course of the 22-year period?
Yeah. So the question is, how many trades, how many round trips would you take during this time period? And it averages about 3, and we're going to talk more about the trading in a second, but it's about, using a 50-day moving average, it's about 3 per year, 3 round trips. Okay. So back to our risk reward chart again, trying to discern how this helps us get in the upper left quadrant. We've got our junk bond index, just the buy and hold of the junk bond index, and that red diamond there. This gets us further up into the left-hand quadrant with some simple timing techniques. Okay. So looking at this graphically, again, this is in red, we've got the S&P 500. In green, we've got the Merrill Lynch Master 2 Index. And in yellow, we have the results of timing the junk bond index using a 50-day moving average. You can just visually see that particularly during the drawdown of 2008 here, it went flat. A little bumps along the way, but basically flat. Again, avoiding the large drawdowns in your portfolio is critical to our success as investors. By avoiding that, we had the ability to preserve our capital and create new wealth when market conditions warranted us getting back into the market. While we don't like using cash all the time, cash can be a very valid asset class. Keep that on your list because sometimes cash is providing the best return in the market. So looking at it more quantitatively on the bottom, basically I've provided for the S&P, the junk bond index, and the time strategy, I've provided an annualized return, the Ulcer index, the Ulcer performance index, the maximum drawdown, and the standard deviation. I've also highlighted the best values in green and the lowest values in red, just to help discern what you're looking at. And over this time period, the S&P provided 5.7%. The time strategy provided about 10.6. More importantly, in my opinion, more importantly, is the risk metric associated with those returns. Max drawdown over 56% on the S&P 500. Obviously, that was during the financial crisis, and with just less than 6% on the time junk bond strategy. So significantly less downside volatility. You can see the same metrics in the Ulcer index. Remember, Ulcer index, the lower the value, the less volatile it is. UPI, the higher the value, the better risk-adjusted return we're receiving. And then there's standard deviation. Any questions on that chart? Because that's kind of a summary of everything that we have just talked about so far. Okay. Must be doing a good job here. Haven't lost you yet. All right. So, what are junk bonds doing today? So this is a recent one-year chart. I think I took this earlier this week, on October 14th. This is the end of what I call the fourth quarter meltdown, 2018 fourth quarter meltdown, if you recall, when stocks sold off pretty strong. Junk bonds, not surprisingly, sold off along with the rest of the stock market. When the stock market bottomed, junk bonds bounced along with them, quickly regained their 50-day moving average, and have been steadily climbing above their 50-day moving average ever since. It's kind of bounced off its 50-day moving average 3 times now, but still providing a upward trend in the market. So with junk bonds still in today's market environment are currently positive, and in this strategy we would continue to own those junk bonds. So before I move on to the next section, this strategy also works for other low volatility asset classes. So, and this strategy works because of the underlying volatility of the junk bond index. And remember, we're not talking about individual junk bonds here. We're talking about a pooled asset or pooled vehicle of many junk bonds. We're not talking about single individual junk bonds here. It has to do with the fact that when we pool a bunch of junk bonds together, it spreads the risk out that any one junk bond failing or defaulting becomes very low. It's kind of like health insurance, right? When you provide health insurance, you're providing a health insurance to a pool of people and you're spreading the risk over. And that's what makes this such a low volatility asset class. So the question is, what are the results of using other moving averages? And so, hold on, I've got a slide on that coming up in just a second, okay? Yeah. Yeah, so the question here is a great lead into the next section, is how do we get access to it? Do we buy an ETF of a junk bond ETF like JNK or HYG, or do we buy a mutual fund? And so we're going to talk about that in this next section. I don't. So the question is, do I have anything that shows the correlation between junk bonds and treasuries? I don't have anything specific on the actual quantitative results of that. But if you remember back to that original slide that I showed from 2011, where treasuries shot up high and junk bonds were falling, that's going to give you a pretty good indication that there's not a strong correlation between the two. There is in certain time periods when you get a positive economy, strong market, interest rates are falling, they're both going to tend to trend up together. But as soon as that stable environment resolves to the downside, where the economics, the overall economy starts to weaken, that correlation is going to go out the window. Yeah. So, okay, let's time check here. Okay, I think we're doing pretty good. So anyways, the point I was trying to make is that this strategy works because of the underlying volatility of the asset class. So if there's other asset classes that we can identify that have low volatility, strong returns, this timing strategy can work. It will not work for equities. You cannot use a moving average to time the stock market. The S&P 500 or the NASDAQ is way too volatile. You will get whipsawed all day long and you will end up with losses. I can guarantee it. It has to do with the underlying volatility of this. So other low volatility asset classes are preferred securities, floating rate bonds, high yield municipal bonds, muni bonds. So there's other asset classes that have these similar risk and return characteristics that make them attractive to this style or this type of approach in the market. So, yeah, question. Investment. So the question is, how about investment grade corporate bonds? Investment grade corporate bonds tend to have low volatility characteristics, so they could provide a similar, a reasonable result by timing them with a moving day, with a moving average. I don't think you would see the upside potential in corporate bonds as you would in some of these other asset classes like junk So let's talk about implementing this strategy. So we talked kind of about the theoretical aspect of the strategy. Let's talk about how do we implement this strategy. So first of all, the question I often get is, how do we get access to this junk bond index? Not available many places. I use a tool called Fast Track. Do we have anyone in the room who uses Fast Track? Not a single person. Oh, one? Yay, okay. So it's available in Fast Track. Fast Track's a charting and analysis tool. Those are where all these charts primarily have come from. The index is also available from the Federal Reserve, and that's the chart that you see here. Are you familiar with the Federal Reserve Economic Data website, the FRED website? Okay, so there's a wealth of information on there. One of the indices that they provide is the high yield Master 2 index. And I put a link to their website, and simply when you get in there, search for ICE, B of A, Merrill Lynch, US Master 2 high yield index, total return index value. That will get you to this chart. You can see it looks very similar to the charts that we were looking at earlier. So that's how you can get access to it. That's how you can track it. I did find the index on TDA's Thinkorswim platform. If any of you use that, I don't know if I could get back to it. It was very challenging to find. But if you look hard enough, maybe make a few phone calls, it is also available on that platform as well. So those are the only three places that I've ever come across. Problem is, we can't invest in an index, right? We can't invest in an index. We need to have some substitute for that index. You can't invest in the S&P 500 index. You have to invest in SPY, for example. So what I've done, the red line is the Merrill Lynch Master 2 index. The green line I put up here is a equal weighted grouping of 10 large high yield junk bond mutual funds. So just a 10%, 10 of them in there. So it's a 10% weighting of each of these 10 mutual funds. You can see the mutual funds do a pretty good job of tracking the index. Not surprisingly, it's provided a slightly lower return though. Why would that be? These, exactly. Mutual funds want to collect their money for providing access to these instruments. So you can see the returns a little bit less, not much. 6 points over this time period was 6.7 versus 6.3, not too bad. But more importantly, we need to look at the risk side. 1.3 for the index and 1.23 for the mutual funds. They've actually provided returns on slightly less volatility, which is always good. The lower the volatility, the more risk we can take out of this strategy, the better it works. Well, that's actually a good thing. Well, what about ETFs? Can we use ETFs? You can, but you're not going to get the results that you want. And this is why. So here, I've got the red and the green line. These are the same two we saw on the last slide. And I've plotted HYG, which is the junk bond, one of the junk bond ETFs. Provided slightly lower return, right? We went from 6.5. The mutual funds provided about 5.73, and the ETF provided about 4.8. So we're losing a little bit of upside potential during this time period. But look at what happened on the volatility side. We went from 1.5. The mutual funds, again, provided less volatility than the index itself. That has to do with really manager expertise and selection. But look at the ETF, 3.44. Significantly higher day-to-day volatility. Because of that increased level of volatility, it provides results that just aren't quite as good as you may want. Question in the back. I think there's a variety of reasons. I think it has to do with the ability for investors to get in and out of those ETFs on a daily basis, which you can't necessarily do in a mutual fund. So those mutual fund assets tend to stick around longer. I think they're also using some derivative products in the ETFs that tend to be a little more volatile because to support the liquidity requirements of the ETFs. So I think it's a variety of reasons. But at the end of the day, whatever the reasons are, the important thing is what does it do to the strategy? And what does it do to our results in our personal portfolio? That is true. But you can, there's not many ETFs. There's JNK. I could put JNK. The reason I picked HYG here is it had a longer track record. But JNK, you're going to see the exact same results. So the question is, if you picked any one of the mutual funds, you might see a similar level of volatility as the ETF.
Because you're comparing a pool of assets, as you said, versus a single one.
Yeah, I get your point, but the mutual funds in general are a fraction of the volatility of the ETF. I mean, you can go, I could put up individual mutual funds here, and you're going to see a very similar chart. You know, of course, there's always mutual funds that are outliers that they invest, have a higher proportion of their assets in a particular industry, like energy, which will increase volatility. But as a rule, most of the big most of the big mutual funds, the PIMCOs, the BlackRocks, you're going to get results that look like the green line on this chart. And the effectiveness of this strategy really, as I said before, depends on the underlying volatility of whatever asset we're timing. And so, if you time the strategy with an ETF, you get the, well, first of all, let me start from the top. The red line is the Master 2 index timed with the 50-day moving average. The green line is the timed junk bond index, if you will, the average of the 10 junk bonds with a 50-day moving average. And the orange line is the time strategy using HYG. You can see the results are 11, 10.5, and 6.1 in terms of annualized return for this time period. And the only reason I picked this time period is that is the history that exists for HYG. Volatility, 0.86 for the index, 0.8 for the mutual fund, and almost 2% for the ETF. And so you can see, just visually, which line would you prefer to be in? You can't be in the red one, right? That's an index. So you have a choice between the green and the yellow. I would suspect most everyone in this room would probably prefer the green line. Correct? Yes. Okay. And so the green line just provides results that are consistent with our desire to make a reasonable return and managing risk. Oh, here I've got them all highlighted for you. So selecting a junk bond mutual fund. So assuming that we're going down the mutual fund route, there are many mutual funds available out there. I always recommend looking at dividend adjusted returns, charts that show dividends being reinvested into those assets. If you excluded the dividends, you would look at the chart and say, Rob, this doesn't make sense. You want to reinvest those dividends. You want to look at dividend adjusted charts. So the question is, what services provide these dividend adjusted charts? The best source of dividend adjusted returns, in my opinion, is Fast Track. That's the tool that I've been showing here. They've got two tools available. One is more of the legacy tool that I continue to use because I've been using this since the early 2000s. They also have a web-based tool that is available. So they've got two different tools. If you go to investorsfasttrack.net, check out their website for their tools. Other providers do provide dividend adjusted charts, but sometimes it's hit and miss. One time I was on a Bloomberg chart. On the bottom of the chart, it said dividend adjusted returns. And I looked at each other and said, there's no way. And I pulled up a chart, fast track, and compared them. There were no dividends in that. So even though they say it, double check it, make sure they're actually incorporating the dividends, because you would think Bloomberg would provide those, and it didn't work. So services are getting better. I think Yahoo is trying to be more consistent in their including their dividends these days. It's been very, very different than it was just 3 to 5 years ago. So they're getting a lot better. But whatever tool you use, you don't have to use Fast Track. It's just the one I use. Just make sure that those dividends are included. Select funds that meet your personal objectives. And what I mean by that is, are you a very conservative investor? You want to look for funds that have lower volatility. It goes back to the point this gentleman was making. Not all mutual funds are going to provide the same level of risk and return characteristics. If you're looking for a little more upside potential, maybe you select a fund that recently had a very large sell-off. Maybe we went through a correction in the market. A particular fund had a steeper sell-off than the junk bond market as a whole. Typically, those funds are going to have more upside potential when the market rebounds. So look at funds, look at charts, make sure that the fund that you're selecting is actually something you want to own. And the only way I know I'm doing that is actually looking at the chart and visually seeing that.
But does that mean you use the dividend adjusted to calculate your 50-day moving average?
Yes. So, yeah, the question of including dividends when calculating the 50-day moving average. Absolutely. Otherwise, you will get results that are inconsistent with what you're trying to accomplish. Before purchasing, of course, understanding the fees. Some junk bond mutual funds have short-term redemption fees, 1% if you don't hold them for at least 30 days. It's pretty easy to avoid those types of situations. There's many funds available that do not have redemption fees on them. Just make sure you understand what you're buying before you get into them. Making sure that once you find the fund, it's available on your platform. Make sure you don't buy a front-end load fee. A lot of the A shares are out there. There's a lot of great funds out there, but typically A shares have front-end loads. So it's like buying a new car. You drive it off the lot, it's worth 2, 3, 4, 5% less than what you thought it was going to be worth, because they take that percentage at the time you purchase it. There's ways around. There's ways to purchase those funds without those front-end loads, but we can talk about that off to the side at a later point if you're interested. And if you sell a fund, don't immediately buy back that same fund. There's a lot of choices out there. Mutual funds tend to be a little bit picky in terms of frequent trading. So if you sold the BlackRock fund, go ahead and buy PIMCO's fund next time. And that way you avoid getting in trouble with the mutual fund company. It's very manageable. And one of the advantages that individual investors have versus, say, a professional investor or investment advisor is that you may be moving a little less money, and so you're not quite as high on their radar screen when you see, 5, 10, 15, $20 million coming across a particular fund. You're trading $100,000, $250,000 at a time. Tends to be below their radar screen. But even though you're below the radar screen most of the time, you don't want to get on their bad side. And I've been doing this for quite some time. Knock on wood, I have not been banned from any fund yet. I've got a few warnings, but I have not been banned. And this is, I personally believe this is a gift to individual investors, this strategy. Institutions cannot perform this type of strategy. There's just not enough capacity to do this. There's just not enough mutual funds available to make this happen at a very large scale. And so this is a gift to be able to have a reasonable return, low volatility, that frankly many people don't know about. So the last thing we want to do is get on the wrong side of the mutual fund companies and mess this up. So just be conscious of what you're doing, what you're trading. Don't trade too often with any one particular fund family. Dale?
How do you buy mutual funds as opposed to ETFs
Yeah.
easily as an individual investor?
So mutual funds are available. I don't know, who do you trade through? TD, Ameritrade, Schwab, one of those. It's just a different section of the website. It's very, very simple. You put in the dollar amount that you want to buy, you put in the ticker symbol, and you submit your order. It's pretty simple. It's actually more simple than trading ETFs.
So I have experience doing that, but it's like 5-7 years ago, and a long time ago, Schwab wanted $65 for a one-way trade on a mutual fund, which I thought was a little bit high if it wasn't their mutual fund. So I don't know what their current strategy is, but could you comment on the fees that the brokers charge to trade mutual funds that are not part of their family? Say you're on Fidelity and you want to trade a PIMCO fund, or Schwab and you want to trade a Fidelity fund. How does that work?
Yeah, so obviously fees are important. Trading fees are important. And it all depends on your platform. If your platform is charging you $65 a round trip for a mutual fund trade, well, I might look around and see if there's a better platform for you to be trading on. So there are options, right? There's TD Ameritrade, there's Schwab, there's Fidelity, there's E-Trade. There's a lot of options out there. If you're interested in talking more specifics about that, I'm happy to talk offline. There's also availability to get on a professional platform where there's very few trading costs. And those front-end loads I talked about are waived. So there's definitely a lot of options there. Just be aware of what those fees are so that you're not surprised once you place that trade. So good question. The question was, what sort of allocation of your total portfolio might you recommend for this strategy? Based on where this sits on that risk reward chart, I look at this as a core part of anyone's portfolio. In fact, for my mom, it's the majority of her portfolio. We're going to talk about how we manage equity risk later on. And we can continue that conversation, I think, after we talk about the equity side, because there's also the potential of combining a really well risk managed equity strategy with this low volatility strategy to provide some really nice returns with a reasonable level of risk. But if you're comfortable being in that upper left-hand quadrant, the results of this type of strategy, for a conservative investor, it could be their entire portfolio. The important thing with that strategy is it's limiting the downside, right? You may not always get the upside. There's no perfect strategy, as we talked about earlier. But this will protect your downside. The Merrill Lynch index that I put up there, if you took a trend line on the troughs, those three troughs that hit the 50-day moving average, that's a 10% return rate. Yeah, so I don't, when I look at these strategies, I'm looking at total return. I don't care if it comes from yield or comes from price appreciation. I'm looking at total return. And so that total return, which is, you are correct, it's a combination of price appreciation and yield. I think the yields are currently So you're getting a combination of both. Yeah, correct. Yeah. Let me, I only have, I don't know, Richard's going to hold me to this 10:15 mark. I got a couple more slides. If I can get through those, then I can take a few more questions. So someone was asking earlier about the moving average. Which moving average should I use? There's nothing magic about the 50-day moving average. So what I've done here is I've plotted the results of the strategy, results of the time strategy using a 10, 20, all the way up to a 90-day moving average. Obviously, with the shorter moving averages, we're going to get a higher return. Our drawdowns are going to be less, right? You can see a 10-day moving average drawdown is about 2.7, 90 days about 7.3. Standard deviation doesn't change much during this time period. So why don't we just use a 10-day moving average, right? That fixes all our problems. We get higher returns, lower drawdowns. The challenge is trading. So the switches per year or round trips go from 9.22, which is probably a little bit more than many investors may want to trade, and more than the mutual fund companies will want you to trade, down to about 2.5. But you see, there's not much difference. Once you get to that 50-day moving average, there's not much difference between the 50 and the 90. And so for our discussion purposes, I tend to use a 50-day moving average. It's kind of right in the middle, that just under three round trips that I talked about earlier. And it's just kind of a sweet spot in the middle there. If you say, well, I want a little more return, go for a 30-day moving average, a 40-day moving average. Again, there's no magic to which moving average. They will all work. They'll provide slightly different results. So that answer your question? I don't know where it came from. Okay. But this is the key component here. So what I'd like to kind of end on here is, why is managing risk so important? So we talked about the theory, we talked about how to implement it, but why would we want to do this? So this is a very hypothetical scenario here. I made it out of thin air. I've got someone retired at the end of '98, right? We're still in the midst of the tech bubble, stocks are racing higher. They've got $1 million of savings. They're going to take 5% of distributions of the beginning balance, 5% of the $1 million, and they're going to increase that by 3% every year. And we had 2 retirees. One uses what I call a buy and hope strategy on SPY, and Mary's going to use this time junk bond strategy that we talked about. Who do you think is going to be more comfortable during the first 20 years of their retirement? Anyone? Mary? Who thinks Joe? Anyone? Everyone's voting for Mary. Okay. And the question is, after 20 years, will either of them have enough money to live another 10, 15, 20 years? And the question is, you want to ask yourself, is why is this? Why are the results that we're going to look at, why are they the way they are? So I just got out Excel and did the math. So there's our $1 million beginning balance. I took out the $50,000 at the beginning of the year. The investment gain on SPY was 20.7%. And we're up to 1.1 million. We're off to a great start, right? Oops, then 2000 came around, 2001, 2002. Those were some down years. So obviously the balance, we kept taking our withdrawal. We still got to live. We got to still support our day-to-day lives. And then we get some pretty good years, right? We get 28%, 10%, 15% in 2006. Then 2008 hits. Another disaster, right? We're down to $400,000. That's a challenge. Because if we keep taking withdrawals at that rate, we're going to run out of money at the end of 2018. And the question is, why is this? Why do we run out of money? It has to do with that 5% withdrawal rate at the beginning turned into 20%, 25%. So if someone was following this strategy, they may not follow this strategy all the way through. They're going to have to make a change in their life, right? They have to go back to work, find another source of income, which is a big decision in life, right? Once we hit retirement, we want to live out of retirement and enjoy it. We don't want to make these big decisions about changing either the quality of life, the things that we do because we can't afford them anymore, or finding another income source. So really, what killed it was the tech bubble, going up to 9% withdrawal during 2002 or 3, 2003. That's really what killed it. And then the financial crisis came in. It was kind of like the dagger in the back, just put this person to rest, because there was just no way they were going to sustain this. So let's look at what happens with Mary. Same $1 million. We have a 5.5% gain. Compare that to 20%. How hard would that be to sit through? You're like, my emotions are taking over. I'd really rather have that 20%. Well, you made a little bit of money after your withdrawal. You really didn't make anything. The next years were all negative years for the SPY, right? The time strategy had some small returns, nothing fantastic, but you're still at $1 million. And then we had a pretty good return in 2003, just like the market had, 2003 had a 28%. We had 27% on the time strategy, did pretty well that year. But notice there's no negatives. There's no negatives. There's no large drawdowns portfolios. So this goes back to what we talked about at the beginning, is avoiding large drawdowns has such a huge impact on our ability to create and sustain wealth. So $1 million grows because we avoided the large drawdown. And our withdrawal percentage, not only did it not reach unsustainable rates, it went from 5% down to 2.7% over that time period. It all has to do with avoiding the large drawdowns. So even though we didn't make that large 20% in 1999, in the end it paid off because of the avoidance of large drawdowns. So again, I ask you what your plan is. I shared with you my plan for the core portion of my portfolios, core portion of my mom's portfolios, and the core portion of my client portfolios. So ask yourself what your plan is and how you're going to deal with the uncertainty of the future. You can read through this stuff here. I'll talk about the surveys and stuff at the end of the other one. So of the next presentation. So any last questions? 10:15 now. Richard, I did okay in timing? It's in the 5% range, yeah. So yeah, so the question is, this was all bond. The discussion this morning was all about junk bonds in particular, but the strategy also works with preferred securities, which aren't a bond. They've got bond-like characteristics. Works with high-yield muni bonds. So there's a lot of bond and income focus with this type of strategy because they're the ones that have that low volatility characteristics that are attractive and work well with this timing strategy. The second presentation I'm giving this morning is about managing equity risk. So I do talk about equities. And that'll be after the break here. One last question.
Since we're in an era of negative interest rates worldwide, mostly, and since your system is based on past performance, the way the funds acted together, how does that go forward? Because we're in an era that never had any history.
Right. Yeah. It was a great question. So the question is, just to summarize, we've been in an era of declining interest rates. Could interest rates go lower from here? Sure. I mean, look at the rest of the world, right? We've got negative interest rates. Could we go from our current 1.75 on the 10-year to zero? Sure, that would be very positive for most bonds. I think your question is what happens when we get to a period of rising interest rates. Is that correct? So during the period of rising interest rates, interest rate sensitive bonds like treasuries, like corporates, are going to suffer, right? As those yields go up, the price on those assets are going to go down. Now, junk bonds tend to be more what I call economic sensitive bonds. They are influenced by interest rates as well, but they're also influenced by the overall state of the economy. And when risk, as we looked at those charts early on, you know, when the treasury shot up and junk bonds shot down, that's still the case. And so when the economy is doing well, if the stock market's doing well, the economy is performing, we've got good growth, those junk bonds are going to do fairly well. And so we can look back at certain periods during this 30-year decline where interest rates did rise for a while, like, for example, between 2003 and 2007. We had a period of rising interest rates, and the stock market provided about an 8% annualized return, and junk bonds did the exact same thing. So will they be influenced? Certainly. But because of the economic sensitivity of junk bonds, they should do okay as long as the economy is doing okay. Yeah. Well, it depends on your tax situation. I can't answer. Yeah, the tax situation, I can't answer your specific tax. It all depends on, everyone's different. And so my goal as an investment advisor is to not maximize or minimize my taxes, but to maximize my risk-adjusted returns.
Thank you. How about if S&P 500 collapsed, and meanwhile, Treasury bill, the interest went down, and also chemical junk bond. So how do you, what would you do among these three asset allocation if that happens?
So the example was, what if the stock market collapses?
Yeah.
Treasury
interest also went down.
Interest rates go down.
Interest go down.
And junk bonds go down. Well, if the stock market's collapsing, junk bonds are likely to go down as well.
Yeah.
And yields were going down,
yeah,
which is common because during times of higher risk, we see that flight to safety,
right,
which drives treasuries higher. Right. So if you've got an environment like that, you got a couple options. You can move your money to treasuries, right? Treasuries are going up, yields are going down. That's certainly a possibility. But in this example, and I said before, cash is a valid asset class. During times of elevated risk, cash is a wonderful place. I loved being in cash in 2008. And that's where I was, and I was pretty happy.
True. At least you have
so was my mom.
Safe. Yeah, true.
My mom was very happy being in cash.
Yeah, yeah.
And so don't forget about adding cash to your list of potential investments. We don't like to be in cash all the time, but sometimes it makes a lot of sense. Yeah.
And how about my 457? I work for the government, so we only have one PIMCO junk bond in the portfolio. We don't have any other junk bond to go with to shift to.
Yeah, I can't speak to your specific plan. The fact that you actually have a junk bond mutual fund in the plan, I think is amazing.
No, because we have other. No,
fund,
but only one junk bond.
The fact that there is one in that plan is amazing, because most plans don't provide access to those types of investments. They're too risky. So don't get me started with that.
So I'm going to make a comment. In 2010, Al Zimlowski made a presentation where he came up with something very, very similar to what Rob's talking about, which was essentially an asset rotation approach. And he showed his example with FAGIX, which is Fidelity, FGovX, which is a government bond fund. And when I've implemented it, I've added a money market fund because sometimes money market does better than both of them. And I'm with Rob, and cashes can be at times a really good investment. So he came up with a way of switching between the two of them. And I just used his thing, and it works. FAGIX actually has something like 38 years of history, and Al even pointed out in his presentation that in the early 90s, it didn't do so well, and that is in terms of returns. But he says, hey, you've got to learn. I mean, didn't do so well for about 5 years. He says, you just got to hang with it, and over the long run, it worked well in his example. So this is a variation on what Rob has presented, which I found very interesting and intriguing. I really appreciate, Rob, your explanation of why it works, because Al didn't necessarily present that aspect of things, but why it works is a really neat and compelling argument to do something like this.
Okay, are we taking a break now?
Yep, we're going to take a 10-minute break. There are bottles of water over here, and the books that are going to be available for the winner of the drawing when we begin the next period are back here. So take a look at it, pick the one you'd want to have if you win. Okay, let's start reassembling. We're going to have a drawing to start with of an investment book, and I hope you've gone back and taken a look at those. We had to rebuy all our investment books after Al passed away, so that was a bit of work. But I'm going to ask Rob to pull a ticket out of here. So do all of you have the ticket you were given when you came in? Did anyone not get a ticket? Rob, do you want to pull a ticket out? You're pulling. You get to reach in there and shuffle them and grab one. Okay, you want to read the actually read the last 4 digits.
115.
It's 6115. Yeah, that's good.
6115.
Who has the book? Who won that? 6115. Take a look at your ticket. 6115. You got it? Okay. Just come up here and pick a book from the table and give, oh, you bet. Yeah. This was our last speaker. And anything you want, just pick one and it's yours. Just leave the ticket on the table here. Okay. Rob, we'll start up again as soon as you got the survey forms you wanted? Okay. Okay, thank you. I'm going to go turn the lights down. Okay, whoever turned down the upper lights, would you flip that switch? I'm not sure where it is. Okay.
We ready to go here? Richard, are we all ready to go? I couldn't see.
Yes.
Thank you. Yeah. All right, we'll get started here in just a second. I think they're trying to figure out the fan.
We're currently arguing with the HVAC system, which has a timer and does not want to stop having the fan blow. So, Rob, why don't you go ahead and start, and we're just going to have to find a way to either throw a breaker and turn it off, or we'll just have you speak loudly so that you overcome the fan.
Okay. Can you hear me in the back with the fan? We're all good? Okay, good, good, good. Okay, I skipped through the survey form I had. There was a survey form in the presentation. I think it's part of, included with your presentation. If you have to leave early, I've got these. These have my little logo in the corner. If you can fill those out, provide me any feedback. What you liked about the presentations today, what you didn't like about the presentations today. That's super useful for me so that I can continue to improve these and make them more valuable to you. There's also some offers here for more information at no charge. So if they're interested, just simply check those boxes. I'll review those more in detail at the end of this presentation. So for this second presentation, we're going to shift gears and we're going to talk about silence. We're going to talk about managing equity risk. This morning we talked about, or the first presentation we talked about, how do we manage what I consider sort of the core portion of your portfolio, that really well risk managed part of your portfolio that has strong day-to-day risk management. Equities is a bit more challenging. Equities are much more volatile, and so they have higher day-to-day volatility, and therefore they don't lend themselves well to sort of those moving average strategies that we talked about. And since the financial crisis, there's been a lot of changes in the market that have made it, in my opinion, more difficult to manage day-to-day risk. We've got influences in the market today that didn't exist sort of pre-crisis, or certainly before the tech bubble, that's for sure. So we're going to talk about those. We're going to talk about some of the reasons why these changes are happening, and then ultimately talk about how we can manage through this, these risk factors, how we can keep focused, remove emotion out of our decision-making process, and stay focused on what the market is actually doing. And so let's dive in here. Oops. This isn't working again. Turn it off, turn it back on again. There, was that me or you? That was me. Okay. Yay. All right, we're back on track. So just want to talk about a few assumptions. First of all, we talked a little bit about this earlier. There is no perfect investment strategy, right? The strategy we talked about this morning, I think is one of the best well risk managed strategies that I'm aware of, but it's not perfect. It's not always going to outperform. It's not going to outperform when the market's skyrocketing higher. It will most likely outperform when the market's collapsing and the economy is weak, but it's not always going to outperform. Even one of the best investors that we know of our lifetime, Warren Buffett, he's even had periods of underperformance. He's provided some fantastic returns over the years, albeit on much higher volatility than the market. But if you look back to, I think it was 99, the market had a 20%, 21% return. He had a minus 18% return. It's almost a 40% differential. That's pretty big. I'm not here to pick on the strategy I talked about this morning or the Oracle of Omaha. The point is there is no perfect strategy. If you happen to know of one and you want to go to lunch afterwards, I'm happy to talk to you guys about it. But there is no perfect investment strategy. So what I'm going to share with you today is not perfect either, but it's a way to get our arms around what's happening in the market and give us some guidance as to what we should be doing. The market environment has changed significantly, as I said, making it more difficult to manage equity risk. There's been some substantial changes in the market, the influences over the market, technology has changed, which has had a big impact on the market. And so I'll talk about some of those and why I think some of those things are here to stay. As a result of these changes in the market, some of the traditional indicators that we use don't work as effectively anymore, and some of them don't work at all. There's one kind of trading strategy that I followed. It was a price, trend, and breadth type modeling system. And going back through time, when both price and breadth were above their respective moving averages as an advanced decline line, it provided 30% returns. When they were both below, it provided negative, it indicated a negative 20% return. And when then one was above, one was below, it was providing a reasonable 12% return. It's a pretty useful tool to have in your toolbox with those kind of indications. If they were both above, you'd have pretty high level of confidence that the market was going to provide good returns. That goes back a long ways. If you look at the period from 2007 to 2016, those results completely flipped. So something's changed in the market that no longer provides those same sorts of results that we've seen in the past. So we just got to be aware of those things so that we don't get too focused on any one specific model or any one specific indicator that may lead to failure at some point in the future. And our goal as investors is to manage risk and seek returns that meet our personal financial goals. It's not to beat the market. It's not even to keep up with the market. How many here want to keep up with the market? Anyone? If you want to keep up with the market, I recommend you put your money in SPY and kind of shut off your computer, and you will keep up with the market. You will get all the upside and you'll get all the downside. But I suspect the reason you're here on a Saturday morning is that probably doesn't work for most of you. If it did, you probably wouldn't be here listening to me, I can guarantee it. So let's talk about some of these changes in the market. I kind of group them into three major buckets. The access to information we have today. Central bankers have a heavy hand over the market, the Fed and the World Banks. And then the algos, the systematic trading, the high frequency trading has had a big influence on what happens in the market today. And I've got an interesting chart to show you. So let's talk about just the access to information. 30, 40 years ago, technical analysis was not well known. It was kind of witchcraft and voodoo. People wouldn't talk about it. Used a moving average timing strategy, or kind of looked at the corner of their eye. What are you doing? Access to information. If you wanted to get a chart, it was very difficult to do 30, 40 years ago, right? You'd have to get the paper. Many people drew charts by hand. If you wanted a moving average, you'd have to calculate that moving average yourself and then plot it on the chart every day. Very time consuming, difficult, much more difficult to get access to information. In the late 80s and 90s, charting tools became more prevalent. Those they cost money. So not everyone had access to those types of things, but it became more prevalent. If you roll forward the clock to today, you can get all that information on your phone, right? For free. I mean, there's charting tools out there. You go stockcharts.com. You can pull up any investment. You can plot a moving average on it. And you can place a trade by sitting at lunch, right? So everyone has access to this information now. And everyone's talking about it. On the news, they talk about, oh, we're bumping up against the resistance level, the top of the trading range in the S&P 500. Is it going to break through this time? I mean, I wouldn't be surprised if my Uber driver on the way to the airport this afternoon is going to be talking about the same thing. Everyone knows about it. And something that everyone knows is probably not worth knowing, right? Because people start to, if everyone's doing it, it becomes more effective. You've got more people doing it. People start trying to get ahead of it. They say, oh, it's about to hit its 200-day moving average. I'm going to make this trade to get ahead of it and get the big bump that comes afterwards because everyone else is going to be following it. So it just makes all these things less effective. And so access to information, I think, has created changes in the market, created changes in the way some of the tools and techniques that people have used in the past, they're either less effective or not effective at all. Central bankers, since the financial crisis, they've had a heavy hand in the market. Not only the Federal Reserve here in the United States, but the central banks around the world, right? The ECB, the Bank of Japan. And their whole goal back since the financial crisis was to stimulate growth, right? They reduced interest rates to stimulate growth. They implemented quantitative easing programs. I'm sure you're all generally familiar with this, where they flooded the market with easy money. They bought bonds, held them on their balance sheet. They bought these bonds from large banks and institutions. What exactly happened to the money that went into those banks and institutions is probably less clear, but one thing we know is that money tends to flow to where it's treated best, right? And where has that been? It's been the stock market. We looked at that 20-year chart of the S&P 500 since the financial crisis. It's been going up at a rate of 15% annually. We're getting into a little bit of volatility over the last couple of years, but besides that, it's been going straight up. And any time there's any hint of weakness or market decline, central bankers run to the nearest microphone. All they have to do, they don't have to implement a program. All they have to do is say they will support this market in the future. So if this continues, they're going to support it. And people start buying ahead of the curve. And this is a chart of the 2018 fourth quarter meltdown. It still doesn't work. That was the bottom. What happened? What happened here? Well, Jerome Powell got up to the mic and said he's going to, he did a 180, basically. He said he was going to have 3 to 4 interest rate hikes during 2019. That's what led to this, partially led to this decline. He got to the microphone and said, well, yeah, maybe that's not a good idea. Maybe I shouldn't raise rates throughout 2019. And in fact, he's been lowering rates in 2019. And so the central bankers have a way of controlling the market environment, and it's created these V-shaped bottoms. Those are hard for investors to deal with. If someone sells out, they're like, oh, this is going nowhere. This is not going in the direction I want. I'm selling out, getting out. And boom, someone steps up to the microphone, and boom, it goes the other direction. So much harder to deal with. This chart I absolutely love. I think this is actually comical. So we talked about algorithmic trading, systematic trading, which now represents, the last statistic I saw, somewhere between 80 and 85% of the market is systematic trading. And so this chart, and as a result, it's creating these larger swings in the market. The market goes too far in one direction and then comes back, whether it's up or down. It's impacting both sides. But this chart is great. This was from December 4th last year. This is a 1-minute chart. On the opening of December 4th, the 200-day moving average of the S&P was going to be 2761. And the market sold off during the morning and hit that 2761. And then in the next hour and 40 minutes fell another 2.14%. But what's really interesting, this is the index itself. I overlaid the volume of SPY. What happened at that exact minute? Look what happened to volume. The volume skyrocketed. I don't know, is that 3, 4 times at least? Do you think that was anyone in this room calling their spouse saying, you know what, it hit the 200-day moving average just now. I think we should probably start selling. Do you think it was anyone in this room? I don't think so. I think it's systematic trading. And volume just skyrocketed the second it hit that 200-day moving average. So I think we're dealing with forces that just weren't present 10 years ago. And as a result has caused changes to the market and changes in the way we look at managing equities. So,
yeah, along that line, I run investor relations for a $20 million market cap software company here. And as of June 30th, 50 of our largest 25 shareholders next time they talk about active investors
So it's supporting exactly what we're talking about here. So, interesting. So what do we do as individual investors to deal with this new environment? What do we do with this increase in volatility, the increase in systematic trading? We don't know when the Fed is going to step up to the microphone and either announce an interest rate hike, sequence of interest rate hikes, or reductions. Do you think we've seen the last of QE? I don't think so. The ECB just recently introduced another round of QE. And Jerome Powell has said he will continue to support this expansion until he doesn't, right? At some point, it will end. Yeah, well, that's a whole nother story. Yeah, I'm not here to talk politics. So in any event, so as individual investors, we need a way to deal with this. And because certain metrics, certain indicators, certain models, we can't rely on, what I've done, again, this is my plan, is to go to a weight of the evidence approach to dealing with equities. And what I mean by weight of the evidence is taking a look at indicators and models that represent different parts of the market across different time horizons, short term, intermediate term, long term, to get a sense of what the market is doing. What should the market be doing? And by building this up, we're not putting any reliance on any single indicator, right? That has a propensity to possibly fail. I gave you the example before of an indicator that worked well for many, many, many years. And all of a sudden, since the 2008 financial crisis has flipped, providing actually the opposite signals that you would want to do. So I break this down into different categories. The first is technical indicators, primarily price trend and momentum, right? Momentum being the rate of change of prices. And this helps us understand what the market is actually doing, right? Is the trend of prices moving up, or the trend of prices moving down, or the trend of prices moving sideways, which is basically what's been happening in the recent market environment. We've got fundamental indicators, indicators that track what the market should be doing, right? Is there a strong economy? GDP growing or shrinking? How are retail sales, for example? Are earnings growing? Are they flat or are they declining? Is monetary policy accommodative? Is it supporting a growing economy? Or is it restricting it? We've got inflation. Typically, periods of lower inflation are related to periods of economic growth. And then there's valuation of stocks. Are stocks expensive? Are stocks cheap? So this gives us a view into the fundamental side of things. We've got credit conditions, which I look at as the canary in the coal mine, right? Credit tends to be somewhat of a leading indicator, and so it can tell us what we might expect in the future. And then lastly, we have what I call early warning indicators. You know, has the market gone too far, too fast in one direction, either up or down? And what is investor sentiment telling us? Are investors bullish? Are they bearish? And how extreme is that sentiment? These tend to be terrific contrarian indicators to help us decide and understand whether the market's gone too far, too fast in any one particular direction. So by looking at all of these indicators, technical, fundamental, credit, early warning indicators, we get a broader picture of what's happening in the market, right? We're not focused just on technical. We're not just focused on fundamentals. Because I think they're both important. technicals telling us exactly what's happening. Fundamentals drive what happens in the market for the most point. There's certainly a lot of noise, but fundamentals typically drive what's happening in the market. So I developed this and for my own use, and I started sharing it with the San Diego chapter of AAII. And we would talk about, we have a SIG group that's called the Risk Management SIG group. So we talk about these types of indicators and models, and they wanted a way that I could share this with them on a more frequent basis. That group meets on a quarterly basis, and they wanted this information much more frequently. So I developed what I call a scorecard as a way of communicating what's happening in the market. So I hope you can see this. Is this big enough for anyone to see? Not really. Okay. Go ahead. Yeah. Can you zoom in? Is it Chris? There's a zoom. Here. Can I show you? Yeah, you can do it in slide mode. So there should be. No. Okay, so if you could just kind of highlight that. Is that better? Let's see. There we go. There we go. All right, so I'm going to ask you to kind of, if you could move around, as we'll leave it on this for just a second. So, okay, so let me walk you through the scorecard. There's a lot of information on here, so let me take a few minutes to walk you through what you're looking at. On the left side are the different models and different indicators. So you can see we've got trend, momentum. These were the things that we were talking about before, right? Fundamental, credit conditions, and then on the bottom we've got our overbought, oversold, and our sentiment indicators. Going across the top, we have current signal. The current signal is just, if I was to use any particular indicator in isolation, what is it telling me to do? Right? So the short-term trend rating is telling me it's in a buy position. So it could be in a buy, it could be in a hold, or it could be in sell. Those are three states that it could be in. The indicator rating is positive, be moderately positive, neutral, or negative. Okay? And these are different, although hold and neutral seem to be matching up. This is from, I think, October 14th. I can't see the date, but I think it's October 14th. But sometimes the current signal could be neutral, but it could still be in a buy position. Okay, so it's not a one-to-one correlation there. And then the last column is the return of the S&P 500 while that indicator is in its current state. I'll say that again. So it's the return of the S&P 500, the historical return of the S&P 500 while that indicator is in its current state. So for example, the economic model that we use is in a positive state. And while it's in a positive state, when we look back over time, history, it has returned an 11% annualized return when it's in that state. Does that make sense? Okay, you guys are smart. I had a hard time with that in San Diego for some reason. So those are the three columns. So now let's go down and let's look. What I want to do is kind of review what each one of these are, so you have an understanding what supports these. So there's a chart that supports every one of these. And I've provided an appendix. We're not going to go through every single chart here today. We just don't have time. But I've provided an appendix with the charts that support each one of these indicators. The sources of this information comes from different places. Stock charts, it comes from Fast Track, and it comes from Ned Davis Research, which is a international institutional research firm that provides research for hedge funds, pension funds, endowments, those sorts of things, advisors. So they've got a wealth of information. So it's a combination of those three that supports what you're looking at here. Now, I can share with you on a regular basis the stock charts, and I can provide on a regular basis the fast track charts. I can't provide on a regular basis the Ned Davis research information because of our agreement. So I have provided the appendix. The appendix will not be available on the Silicon Valley AAII website. If you would like an electronic copy of that appendix on that little survey form that you had, just ask for an electronic copy of the presentations. I will send you not only the electronic copy of the two PowerPoints we're looking at today, but also send you an electronic copy of the AAII. I just can't, of the appendix. I can't post that up on a public website. So please let me know if you're interested in that. So the first section is the primary cycle. So it's useful to understand what kind of market we're operating in. Are we in a long-term or secular bull market? Or are we in a long-term secular bear market? And the definition of a secular or long-term bull market is just a market that's providing above average returns. And a secular bear market is a market that's providing below average returns. It does not have to be negative. So if you look back the first 13 years, called 10 to 13 years of this century, we were in a long-term bear market, right? We had periods of up and down, but over the long term, we were below average. In fact, over the first 13 years, we had virtually no return. Since the end of the financial crisis, we've been in a long-term bull market, and that's what's reflected in the indicator rating there. The cyclical market cycle is the shorter-term market cycle. So the secular trends tend to be in the neighborhood of 5 to 20 years. They're very long-term trends. The cyclical market cycle tend to be shorter. So this is, what is the shorter trend within the context of the larger, longer-term trend? So if you go back to the 2000 to 2008 period, we had 2000, 2003 was a cyclical bear market within the context of a secular bear market. And then we had 2003 to 2007, which was a cyclical bull market in the context of a cyclical bear market. Does that make sense? They haven't lost anyone yet? Okay. And so that's the difference. So we don't really make any investment decisions based off of the market cycle, but it's just useful to know where we are in the overall cycle. So next we move into the trend section. As I said, we like to look at multiple indicators across multiple time frames. So I've got a short-term trend, an intermediate-term trend, and a long-term trend. And this is basically taking a look at the S&P 500. On a short-term basis, it's taking a look at the S&P 500 and comparing it to its 5, 10, and I think it's 39-day moving average. And the relationship of the price compared to the moving average and the relationship of the 5-day moving average to the 10-day moving average, and I make an assessment. So this is somewhat subjective when I'm looking at this. Same with the intermediate-term trend. Although on the intermediate-term trend, we're looking at weekly charts and comparing the price of the weekly chart to its corresponding moving averages. I've actually included that chart. We'll look at a few sample charts today. We'll take a look at that one in a minute. And then we've got the long-term trend, which is simply a 50 and 200-day moving average. And we talked about, access to information at, 30 years ago, people used to use the 50-day and 200-day moving average as a trading system, right? It worked okay. I don't think many people use that anymore. It's very well known. It's the death cross. The CNBCs love the death cross. What's better than a headline? The death cross has been breached. But it's still useful to help us understand what the long-term trend is. So we move into momentum. The momentum models, we have a short-term, an intermediate-term, and a long-term momentum indicators. The short-term momentum indicator is based on a all-cap weighted index comparing it and comparing it with its advanced decline line. So it's sort of a price trend as well as breadth indicator to give us momentum on a short-term basis. The intermediate term momentum model is based on an index of 157 what they call sub-industry groups and the price movement within those groups. This is a chart provided by Ned Davis Research. Has done a great job of helping us stay on the right side of momentum on an intermediate term basis. So how are those 157 industry groups on a percentage basis? Are they do they have positive momentum comparing it to their current price to the price 6 weeks ago? Is it rising? Is it falling? And the long-term momentum model is based off the same index of 157 sub-industry groups that takes a slightly different take on it. So that's where we get our momentum indicators. The fundamental side of things, we look at an economic model produced by NBR. We look at earnings of the S&P 500. You know, are earnings growing? Are they declining? And based on those models, we have access to, you know, it's shown over time that when earnings are falling, the stock market typically declines as well. That makes sense, right? We look at monetary models. There's actually two monetary models. We look at an inflation model, and we look at a valuation model. There's actually two valuation models that roll up into that one line item. Going down to credit conditions, we look at short-term credit conditions. The short-term credit conditions is based actually on the junk bond index. I think the junk bond index that we talked about this morning, if I had one indicator to track the overall stock market, if you said you could only pick one, this would be it, is the junk bond index, because it does a great job of giving us an overall indication of the health of the economy. When junk bonds are trending up above their moving average, it's an indication that investors are willing to take on risk. And when risk elevates, they demand a higher, is what we talked about this morning, they demand a higher yield to hold that additional risk, and therefore, junk bonds tend to trend down. So it's a fantastic indicator. I think it's probably the most consistent indicator in terms of the overall health of the economy. The intermediate term credit conditions is based on, let me go back. The short-term credit conditions is based on the junk bond index in relation to its 50-day moving average. The intermediate term credit conditions is based on a moving average crossover of the junk bond index of the 30 and 126-day moving average. And again, all this is in those appendices, so when you get back home, you can take a look at all this. And the long-term credit conditions model is a model produced by the Chicago Federal Reserve Bank. It's a financial conditions index that they produce, and there's a credit conditions sub-index, which is what I use. And it's done a pretty good job on a very long-term basis. We talk about long-term here, but this is a very long-term indicator of overall credit conditions. It looks at a multitude of different inputs, and anytime, and it compares it to the average over a long period of time. When it's above its average, it's signaling weaker times ahead, and when it's below its average, it's indicating supportive credit conditions. And again, there's a chart in the appendix that you can take a look at. It's available on the Fed's website. But it's done a pretty good job of forewarning of coming recessions. Right now, the index is at about minus, last time I looked at it, was about minus 0.6, which is indicating a very positive credit market environment. So those are those four inputs. Now we get to our early warning indicators. The first are our overbought and oversold indicators, short-term, intermediate term, and long-term. And basically these are all contrarian indicators. And so when the market gets overbought, think of a rubber band. When a rubber band gets stretched and you let go, it goes back towards its natural state. So that's what we're talking about here, is trying to get a sense of whether the market's overbought or oversold. So if the market's going up, you know, has it gone up too far too fast? Or if it's oversold, has it gone down too far too fast? And so, for example, the short term is based on the stochastics of the S&P as an example. And then we get to investor sentiment analysis, which is based on sentiment of individual investors, particularly AAII. You guys are fantastic in terms of sentiment. When you guys get bearish, that's a great time to get back in the market. It is fantastic. And so actually the AAII sentiment indicators actually reached a pretty large extreme just last week. And so if history is worth anything, this is probably a good time to be in the market just because of that right there. So it includes the AAII sentiment survey. It includes institutional investment surveys. Halbert is another newsletter guy who tracks all the newsletters. So there's a lot of different inputs into these sentiment indicators. And again, this is a very contrarian indicator. So overbought is going to be red on here. So you see these are all color coded, right? So overbought is going to be indicated with red, because when it's overbought, what happens to the market? It's going to go back towards its mean, which is down from where it is, right? Oversold is going to be green, as it was on October 14th, because it's likely, there's a higher probability that it will revert back to its mean, which is positive for those in the market, right? It's going to go from a low point back up to a higher point. Does that make sense? And contrarian indicators get a little confusing. Does that make sense for everyone? Okay. So let's, and then at the bottom here, so we take the weight of the evidence for those that I have access to the historical data. We average this out, and based on the current conditions in the market, it's saying that the S&P has provided on average a 13% annualized return. Not too bad, right? There's a lot of noise in the market today. How many would have guessed that this is such a positive market? Right? There's a lot of noise. There's a lot of political things going on. There's the Federal Reserve. There's Syria. There's trade wars with China. So there's a lot of noise. And the purpose of this weight of the evidence approach is to kind of filter through all that noise to get down to what's actually happening in the market. So according to the scorecard, it's a fairly positive time to be in the market. We got sentiment that's actually supporting a upside move in the market. Pretty neutral on the overbought, oversold. Not really too far in one direction or the other. Okay, make sense? So let's look at a couple of sample charts. So this is the intermediate term trend chart that I mentioned. This is a weekly chart of the S&P 500. It's plotted with its 10-week, 30-week, and 55-week moving averages. And when I evaluate this, I'm making an assessment of comparing the price to its moving averages, an assessment of its moving average to each other. So you can see price in the current state. This chart was taken on October 15th. Price was above all three moving averages. The shortest term, the 10-week moving average is rising. The 30-week moving average is rising, and the 55-week moving average is rising. Pretty positive configuration, right? And that's why you see the positive indicator on the scorecard. So I do the same thing with all the short-term, intermediate-term, and long-term trend indicators. We just use different charts, different time frames to make that evaluation. This is the short-term momentum model that I mentioned earlier. It's as I said, it's a equally weighted equity of large cap, small cap, and mid cap stocks. So it encompasses a broad range of the market. The top part of the chart plots the index with its, I think it's a 25-day moving average. And the bottom of it is its advanced decline line. So the advanced decline line is simply the number of stocks moving up, less the number of stocks moving down on any particular day, added to its previous day total. And then they plot a 5-day moving average on it. The great thing with these Ned Davis research charts is these little boxes on the bottom here. So you can see here when both are above their moving averages, the annual gain was 26.35. I say you can see. You probably can't see. You have to trust me. 26.35. If one's above and one's below, it's provided a reasonable 14%. And when they're both below is the current state in on whatever date this was, probably end of last week, with a minus 20% annualized return. So it's very helpful to go back through history to see how these different charts behaved during these different configurations. So that's from the beginning of time. This box simply represents the view of the chart, which goes back to 1998. Okay, so right here, they're both below their smoothing, which is a negative. The reason this is, I think this is different than this, what the scorecard's reflecting. What does the scorecard reflect? Does anyone have that up on the short-term momentum? Anyone? No? I think it might be different, and the reason for the difference is it's the chart's from a different time period than the actual scorecard was taken. This is a sample chart of the economic model that's provided by Ned Davis Research. You can see the top part is the S&P 500. The bottom chart is the result of these 15 different economic indicators that they use in their model. It includes GDP, it includes retail sales, building permits, et cetera, to get an overall state of the economy. And you can see here in this box, that's that little box there, when this is 80 to 90, it's provided a strong 24% annualized return. When it's between 60 and 80, it provides about a 10% return. When it's neutral, as it is currently, which is 40 to 60, it's provided about 11% return. When this economic model goes bearish or very bearish, you can see the returns turn negative. And so, again, it's just very helpful to have this historical track record of how these models have worked during different time periods. And again, we don't want to rely on any single model, because if you rely on any single model, that's certainly to not provide consistent results over time. And then this is the last sample that I have in here, which is the short-term credit conditions, which is simply the Merrill Lynch High Yield Master 2 Index that we looked at this morning. See, it's trending above its 50-day moving average. And as a result, the short-term credit conditions is indicating a positive reading. So that gives you an idea of how I use these charts to develop the scorecard. There are sample charts in the appendix that you can take a look at when you get back home to get an understanding of how each one of those models works. Okay. Richard, I have till what time? Noon? At 11:45. Oh boy. Okay, so I'm going to cut into your Q&A time a little bit. I apologize. So what do we do with all that, right? So that's a lot of information. You know, one way you can use it is say, hey, look, the scorecard's all green. That's fantastic. It must be a positive environment. I'm going all in, right? Or maybe I'm going to use leverage. It's all red. Obviously, it's indicating a pretty weak market environment. But I thought it'd be more useful to help quantify what all this means. And so I've taken the four models, the trend, momentum, fundamental, and credit conditions, and given them each a 25% weighting. And based on the results of each of those indicators and their readings, provided a potential equity allocation. Now, this is not an investment recommendation. Repeat, this is not an investment recommendation. This is designed to be a tool to help give you a sense of what's happening in the market, and designed to be used in conjunction with the other tools that you're already using, not asking you to change what you do. If the other tools that you're using have you 50% invested, and this is saying 85%, it may lead you to ask yourself some questions. And that's the purpose of this tool, is to help have this conversation with yourself. Because people used to ask me, well, how much are you invested right now? Well, I'm not going to tell you that, because I can't, right? It depends on the day and the circumstances. But this is a way that I could communicate an overall equity guide, I call it, not a recommendation. It's more of a guide to help you bounce your current models off of. This one's got me 50, this one says 85. Well, something's going on. Maybe I need to dig deeper and look a little further. This one shows 50%, and I'm 100% invested, or 110% invested. Maybe I should be looking into that. So that's the purpose of this. So how we come up with these numbers is that each of the indicators I assign a weighting, right? So if it's positive, it gets a 1. If it's moderately positive, it gets 0.67. If it's neutral, it gets a half. And if it's negative, it gets 0. I apply those to each one of the models. So I've just taken the momentum model here as an example. I applied the indicator weighting. So we had a neutral, a positive, moderately positive, and a positive. So I assigned 0.5, 0.67, and 1. Pretty simple, right? Next, I take the average. So I added all 3 of those up and divided by 3, and you get 72.3%. Okay? Simple, straightforward math. I said each one of those 4 groups gets a 25% weighting. So I apply 72% of 25%, you get 18%. That's step 3, and that's what you're seeing in that equity allocation guide, okay? So that's where it comes from. There's no magic, no mystery, just doing the math for you. If you, for example, thought, well, trends, what's much more important than momentum? Well, you could recalculate the numbers yourself and come up with your own weighting. I tried to keep it pretty simple with 25% across the board. So how's that allocation guide looked over the course of time? So I went back to basically 2000, and went back and for each one of those indicators, plotted the reading on a weekly basis, and then applied the weightings and did the calculation. So you can see it did a pretty good job in 2000, early 2000s. We spent a lot of time down below this 40, 50% level. 2003 to 2007, we spent most of the time in the upper part. 2008, no surprise there. 2011, that was that weak point. 2015, 16, and there's the fourth quarter meltdown. So it does a pretty good job of getting the overall picture right. Again, it's not intended to be perfection. It's tried to give you guys an overall picture of the market and a general sense of what's happening. Is it a strong positive market, or is it not? And generally, I don't have any magic number, but generally anything under sort of the 50% range, you'll notice it never goes to 0, right? Because one of those indicators is generally going to be positive at any given time, right? In a weak market, you could still have a short-term uptrend in price. And so this never tends to go to 0. It'll certainly get to 100%. You can see there's many times that it got to 100%. It'll never, I can't say never, it generally doesn't go to 0. But anything below that 50% line is a pretty weak market environment. Oops, uh-oh, pushed the wrong button. There we go. So these are the returns based on those numbers that we just looked at. A few things jump out at me here at the bottom. The guide provided a higher return than the S&P. That was mostly a result of missing the large drawdowns in the market. You'll notice that during the positive years, we've never kept up with the market because that's not our goal. Our goal is not to keep up with the market in the short term. But we did, in most instances here, provided a lower drawdown than the market during weak market periods. And as a result, by avoiding the larger drawdowns, we've outperformed. Similar theme to what we talked about this morning, is avoiding the large drawdowns is key to our financial success. This is just looking at this in a graphical format. You know, how the allocation guide compared to the S&P 500 all the way back to 2000. One of the things that jumps out at you is the overall volatility, standard deviation is about a 45% reduction in volatility, from 5.5 down to about 3%. So, question? Good question. I forgot to mention that. So all it is investing purely in the S&P 500. So it's using those weightings. So if it was on a weekly basis, these trades were placed on a weekly basis. So as I mentioned, I went back through time on a weekly basis. I looked at all those indicators, got their current state, and calculated the reading for that week. And so, right. So the trades were placed on Monday. So it uses Friday's data. Trade was placed at the end of day Monday, held till the following Monday, and then readjusted. Yeah. Correct. Yeah, the question was about what's the remainder allocation. If we were only 85%, the remaining 15% would be in cash. The BH, that's on the left side here, BH, it's basically the buy and hold return for the time period shown on the chart. So it just means from the beginning of this chart to the end of the chart, the total return, if you bought and held that, was 70%? Yeah, 70.6%. Yeah. So, so the third tool, so we've talked about two tools. We've talked about the scorecard, we've talked about the equity allocation guide, and now we've got the third in the set is an early warning model. And this is where the overbought, oversold, and the sentiment indicators come into play to help me communicate how I assess the market in terms of whether there's high potential for a mean reversion move, meaning that we're going to move from the current state back to the mean, and whether it's a good time to invest new money. You had new money sitting on the sideline you wanted to put in. I always get the question, well, should I put my money to work now? Again, this is my assessment. There's no guarantees, but it gives you a general assessment based on these 6 indicators, how I'm feeling about the market. So if we were, if everything was green, meaning that we were oversold and sentiment was very weak, these would be green, indicating to be a great time to put new money to work because there's likely going to be a higher probability of a mean reversion. And so that's just a way of communicating the current market state, where we are, and whether or not it's investing money. So these tools, I provide them to the AAII San Diego group. Also make them available to all of you. They're available on my website. And again, I'll just go through here. I've talked about this. It's a general market guide. It's not a recommendation. And it's used to help support your overall investment strategy. If you like access to them, I post the scorecard, the allocation guide, and the early warning model on my website every Monday. You can go to our website under the resources tab. The market is called Market Monitor Tools. They're available there. I also publish a monthly newsletter. It's about an 8 to 10 page newsletter. It's got a lot of charts in it. I just talked about what I see happening in the market, what I expect coming up. I talk about the bond and income side a bit as well for those who are interested in that core side of their portfolio. I provide the 3 tools in there as well. If you subscribe to the newsletter, you'll also get an email from me when, on a weekly basis, when I've updated the website with the other tools, so you don't have to go check to get a proactive indication. The newsletter is produced on, I write it on the 2nd Wednesday of the month, and it's published on the morning after, on that Thursday morning. So again, if you're interested, these are all free. I produce a weekly note. It's just a 1-page note designed for my clients, but I share with others if you're interested about what the market's doing. This is the 8 to 10-page monthly newsletter we just talked about. And then I've got an annual meeting that's welcome for everyone that will be live streamed from November 2nd. If you're interested in these tools that we talked about today, both the conservative side, the core side, as well as some of the equity, I will be talking about how I apply those in my business that I use for myself, for my mom, and for my clients. If you're interested, I know you're up here in Northern California, and I will be in San Diego. If you can't attend in person, there will be a webinar that you can access that. If you want to have access to any of these, just simply, if you want the presentation, just check yes. The newsletter, check yes. Please, please, please write your email clearly. And if you provide your phone number and we get a bad email, and this has happened, we can at least call you to ask you for clarification. If I don't have a phone number, I'll never be able to contact you again. No, there's no online. It's if you want to take it home with you and text the picture to me, you can do that. Otherwise, I just leave it here on the table on your way out, and I'll collect those. But if you don't do that today and you decide later you want to do it, send me an email. I'm happy to put you on those lists. Yeah. And with that, we've got 5 minutes for questions. So the question was about options. I am not an options trader. So yeah, I would not be the right person to talk to. Yes, so the question is, what does my firm do? So my firm came out of my desire to manage risk for my mom and for myself, and it really stemmed out of the 2008 financial crisis, which is what launched my firm. Our success during that time period. So we have different portfolios, some that are focused on some of the lower volatility core strategies that we talked about today. We have a very aggressive one, which is based on some of the concepts we talked about on managing equity risk. And then we have a balanced strategy that actually combines those two. And that's what I'm going to be talking about in this annual meeting. So if you're interested in learning more about that, I would suggest, if you're available, to participate in that webinar. Yes?
Do you consider national debts in your formula of economic growth?
So the question is, do we consider national debt? There are a lot of inputs into these economic models. I would have to double check specifically on the national debt. My guess is, yes, it's in there. Just for example, the economic model that we referenced here is a culmination of 15 different indicators, right? Okay. And so there's a lot of inputs that go into these. So it's really a really broad view of the market.
How about the U.S. dollar strengths relatively to the other currency?
Yeah, I don't believe the U.S. dollar strength is necessarily in any of those indicators that we've talked about. Any other questions? Yeah. So the question was, with the junk bond strategy that we talked about earlier, have I ever considered doing the inverse trade, basically going short instead of moving to cash, I think is what you're referring to, correct? Oh, have I considered it? Yeah, absolutely. The problem is getting exposure to the inverse side. You can't get exposure. You could short an ETF, but again, then you're talking about increased volatility. It reduces the effectiveness of the strategy. It's very difficult to get access to the short side of the index itself, or a short side of a mutual fund. They just don't exist. I mean, there's one mutual fund I know that could go short, but again, the volatility is too high, which means it reduces its effectiveness. Good question, though. Any other questions? That's it. Well, thank you for letting me speak to you today.
Thank you very much.
Thank you, Rob. That was very interesting
Thank you very much.
and fruitful
Thank you.
presentation.
All right.
Appreciate your coming and presenting to us. If the attendees would like to help us out to put the tables and chairs away, we would love to have you help.
And there's a place on the table as you go out to put the survey forms. There's two different ones.
Let me turn this off.